Would you like to save a minimum of 95,000 Rand in income tax? Comment yes below if that is the case. In this video, I'm going to show you exactly how to do it, step by step. My name is R95000 and I'm a professional accountant, and today I'm going to show you exactly how to get this right in a few easy steps. Remember to like this video if you got any value out of this, and leave a comment below if you want to get in touch with me, or visit our website at saaccountingnetwork.co.za. Well, without further ado, let me jump to my computer and then I'll show you exactly how this is done. So in this slide, I'm going to show you exactly how to save 95,000 Rand in company income tax in South Africa. In our Income Tax Act, there is a small section in there which is called, where they talk about small business corporations. So the specific section in the Act itself is Section 12E of the Income Tax Act. So there's two main things that they talk about in the Income Tax Act. The first thing is that they talk about that you get lower tax rates, and the other one that they're talking about is that you're getting faster depreciation rates. So the benefit of those two together, just the one alone, as I will show you in the slides just now, that just the income tax rate, the lower tax rates, you save 95,000 Rand in income tax just by doing that one thing alone. But let me show you. So just jumping back to the slides, you'll see over here is what normal income tax rates are like in South Africa. So for normal companies, you know that you get taxed at a flat rate of 28%. But if you can qualify as a small business corporation, then you can see the first 79,000 Rand, you pay 0% tax. The next amount from 79,000 to 365,000 Rand, you only pay 7% tax. And from 365 up to 550,000, you pay 21% tax. And then from 550,000 up, then it's when you only start paying that 28%. So if you do the calculations, which I'm going to show you just now with the example as well, that you'll see that you actually save 95,130 Rand in income tax. So if you look at just that calculation alone, that's a lot of money that you can save. But obviously with these type of things, there's a couple of requirements, and that's what we're going to work through quickly. And let's have a look over here. So just a quick explanation of how it works. You'll see that the depreciation, so the second one where they talk about the faster depreciation, under normal circumstances with the income tax, the SARS gives us these guides as like a long document that explains to us exactly over what period of time you're allowed to write off assets in your financial statements for tax purposes. So let's say, for instance, you buy something for 100,000 Rand, and SARS says that you can use that asset for a period of 5 years. Then what we'll do for every year, then you can write off as an expense 20,000 Rand as an expense, you see. So this is what we're referring to over here. So just an example that I gave you guys, extract from that little piece of document, is where we're talking about sewing machines. So you can see that if you talk about sewing machines, and SARS says that for sewing machines you can write it off over 6 years. So that is the time period that SARS gives us. If you've owned a sewing machine, that is the amount that you have to use. So it's not something that you have to choose. It's a compulsory thing that SARS tells you what to do. So now, if you look under small business corporation rate, so that same example we were talking about small sewing machines once again, you can see they give you two options. So the one is you can either write off 100% in the same year that you actually brought that asset into use, or otherwise there's an accelerated depreciation where they say that you can write off 50% in the first year, 30% in the second year, and 20% in the last year. So what makes a difference is whether you're using that asset for manufacturing. As soon as you're using it for manufacturing, you can use the 100% as a depreciation rate. If you're not using it for manufacturing, then you have to use, then you can use the other one, the 50%, 30% and 20%. So as you can see on the slide over here, they say under Section 12E, two sets of accelerated depreciation rates potentially apply to assets of a small business corporation. Subject to certain conditions, assets used directly in the process of manufacturing or in the process of similar nature may qualify for 100% write-off in the year of assessment in which that asset was brought into use. Assets that do not fall in this category may qualify for a write-off of a period over 3 years at a rate of 50%, 30% and 20% in the respective years. So you can see just that alone is another big benefit if you can qualify as a small business corporation. So you can see, so here's my little example. Let me just get myself out of the way here so you can see exactly how this works. So under normal circumstances, under normal income tax, if you have a turnover in my example of 2 million Rand and you've got expenses of 1 million Rand, of which you can see that the depreciation on the manufacturing equipment, remember we were talking about the sewing machine. If you take 1 million rand times 16.67 or divided by 6 years, then you can write up 166,667 rand as depreciation. And if your other expenses that you've got in there is 833,000 rand, means that all the expenses together is 1 million rand, which will give you a taxable income of 1 million rand. So now, if you had to work out the tax at 28% on that, the 1 million rand, then you can see your tax works out to 280,000 rand, because it's obviously 28% of 1 million. So now, in the case of a small business corporation, you can see that with exactly the same calculation, if you have a turnover of 2 million rand, then you've got expenses. You can see over there, I see depreciation of manufacturing equipment. So if you're using those sewing machines in the manufacturing industry, then you're allowed to use that 100% depreciation rate that I was talking about just now. So in the first year that you bring that machine into operation, you can write off the full million rand immediately as an expense. So that is what happened on the slide over here. Then you can see other normal expenses is 833,000 rand. So you can see your taxable income came down from 1 million rand all the way down to 166,000 rand. So the tax on that would then work out to 46,000 rand if you're using that small business corporation rates. So you can see on a business of 2 million rand that you actually have a tax saving potentially of up to 233,000 rand. And I mean, that's only for a small business. So, I mean, that in itself is a lot of money that you can save on income tax. So let's quickly run through the requirements, so the stuff that you need to be careful for. So if you look at the requirements, SARS says that there's 4 requirements. The first one is a legal entity requirement. The second one is a gross income requirement. The third one is a shareholding requirement. And the last one is a business activity requirement. So I said over here that you must please check with SARS or a tax practitioner, because if you miss this thing and you're trying to claim these company tax rates as a small business corporation and SARS catches you out, then you're going to be in big trouble, because they're going to give you assessment at the correct rate and possibly even a penalty, and those penalties can sometimes be up to 200%. I've actually seen in the past that companies have to close down because they use the wrong tax rate. So just be careful, and that's why I want to show you now, just so you can be aware of these things that you've got to be careful of. So the first requirement, where they talk about a legal entity requirement, you can see one of the requirements to qualify as a small business corporation is a taxpayer must be a juristic person in form of a closed corporation, a cooperative, or a private company as defined in Section 1 of the Companies Act, or personal liability company. So those are the ones that are allowed to qualify as a small business corporation. So you're probably going to ask me, Heinrich, what is not included in there? The first one is obviously sole proprietors. If you're trading in a personal capacity, you cannot qualify as a small business corporation. And the other big one that we need to be aware of is trust. So if you're operating as a trust, remember, you can't qualify as a small business corporation. So those two are immediately off the cards. So if you are trading as a sole proprietor, this might be a good incentive for you to register as a company and jump on board onto this tax system. Then the second requirement, you can see there's a gross income requirement. So here again you have to be careful, because these rates change every year. So obviously these are relevant to the current financial year, which is the 2019-2020 financial year. So if you're watching this video next year, then just make double sure you go to the Receiver of Revenues website, download the Small Business Corporation Tax Guide over there, and just make sure that you do still fall inside that bracket. So you can see over here they say that, so this is actually an extract from that guide, but I'm going to show you the link just now. I'm going to give you the actual link. So the gross income of a qualifying entity may not exceed 20 million rand for the particular year of assessment. Key factors for consideration: what constitutes gross income, or what is a year of assessment in which a limitation of 20 million rand must be reduced. And then they talk about considerations. Like I said, I'll give you the tax card as well. In the link below you will find it, and on my website you'll find it as well. So just go make double sure about the 20 million rand turnover limitation. The third requirement, they talk about a shareholder requirement, and you can see I marked it in red over there. So the qualifying entity must, during the relevant year of assessment, be a natural person. No part of share capital or members or interest of a small business corporation can be held by a juristic person as such as another company. So that's really important. So any shareholders in the company that you want to try and qualify, it has to be natural people. So if you have one company that owns another company, then that company cannot qualify as a small business corporation. So be careful here. And the next one, They said the holders and shares of members of the acquiring entity might not in any time during the particular year of assessment hold any shares or have any interest in the equity of another company as defined in Section 1. So you must be careful here as well. They say that if I am an owner of one company and I have shareholding in another company as well, there's a couple of small exceptions. It might be a good idea to look through that guide as well that I'm going to give you. But if you own two companies, sorry, then you can't qualify for this. So that's one thing that you have to be very, very careful for over here. The fourth requirement is the business activity requirement. So here, what this whole thing is about, they say that you can see over here, they say if more than 20% of your income consists of investment income, or if it's a rendering of a personal service. So those two things, investment income, personal services, then you cannot qualify as a small business corporation. So this tax was actually originally brought out for people that's actually trading, so people who's buying and selling stuff, or people that's in the manufacturing industry. So that's the type of people that they're actually trying to target with this legislation to help them with better tax rates. So people like if you're rendering any type of a service, accountants are out, graphic designers are out, consultants are out. They say anything that you have a qualification for to be able to consult to somebody else, then you're out the picture, then you cannot qualify for this. You can see I just cut a couple of small pieces out of the legislation and just put it onto the slides. You can see in general a personal service refers to a service rendered of which the income derived is mainly for reward for the personal efforts or skills of an individual. Now there's one small exemption with this thing. They say that if you have 3 full-time employees for the full financial year, with a couple of limitations again built in there, that it's not allowed to be connected persons and stuff like that, then you might still be able to qualify as a small business corporation. And you can see over there, the last point over there, section 12E4A4, excludes any company which is a personal services provider. Then again, once again, in that guide, you'll see that there's a full explanation of what a personal services provider is as well. So if you're not sure about that, get in touch with a tax consultant or even phone SARS, so you just make sure that you're not missing it over there as well. So those are the requirements that you have to be careful for. And as I mentioned over here as well, you must be careful to make sure that you go through this full guide on the SARS website, and you can see over there, I've given you the link over there that you can go look at as well, or otherwise you can download a copy of that guide on my website as well. And just like I said, once again, please make sure with SARS or your tax consultant or accountant before making the final decision if you qualify as a small business corporation. If you're not sure whether you qualify, then comment below and we can get in touch with each other, or fill in the contact us form on my website, and we will also gladly assist to see whether we can get this done. One more thing that I want to share quickly, that guide that we were talking about. Let me quickly see if I can get out of that. So if you go to my website, the SA Accounting Network website, let me just move myself down there again, you'll see that on the main page there's a button on the left, there's on the left hand side that says company tax. If you click on that button over there, you'll see it gives you all the stuff about income tax. And over here I've written a small thing over here about small business corporations, and you'll see halfway down there's the guide that I was talking about. So you'll see if you click on the link, it will actually open up the guide, and you need to make sure that the latest one that you get it from the SARS website. At the time of publishing this video, that's got to be dated 25 June 2018. Then you can see over here it gives you the whole thing. You can see over there is those requirements that we were talking about, the qualifying requirements, legal entity, holding of shares, the gross income requirement, and the business activity requirements. So please do go make sure that you work through this guide, because there's a lot of nitty-gritty involved to this. So if you did receive any value out of this video, then please like my YouTube channel and comment below, and we'll see if we can get in touch to help you to get this thing sorted out, to see if we can get the maximum benefit out of income tax for you. Thanks.